Welcome everyone, and thanks for attending my leg of this really great webinar event today. I appreciate you putting in your time to learn to be a better trader, and I am going to put in my time to help you learn to be a better trader. So I want to ask, how many people here in the audience currently trade options? Just give me a yes for, or a Y for yes, I do trade options, or an N for no, I don't trade options. Just go under questions. All right, so we've got mostly yeses. We got a couple no's. We got some people who trade binaries. Now binaries are a little different than what we're going to be talking about today. And we got Lanu has the best answer. He says, not yet. I don't trade options yet. Well, that's a positive attitude if I ever saw one. I like it. Man after my own heart. All right, so here's what we're going to talk about today. Even if you're brand new to options and you don't know a lot about it, you're going to learn something. For those of you, for most of you who do know something about options because you've been trading them already, guess what? You're going to learn something too. This is a presentation that's kind of for the masses. It's for everybody and anybody, no matter what your experience level is. Specifically what we're talking about today, of course, is high probability trading. Now, you may have people sometimes tell you, oh, well, you know, my trades win 100% of the time. Okay, so that's kind of silly, right? No trades always win 100% of the time. You guys are, you know, students of the market. You're smart enough to realize that that's not true. However, you can set up trades that statistically do have a high percentage chance of winning. Mathematically, unarguably, have a high chance of being successful, high probability. And it's measurable, and I'm going to show you exactly how to do that. Chris says he knows how to lose on buying options. Yeah, well, there's that, isn't there? All right, before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading, and you can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation here in Chicago, which is the center of the universe for option trading. All right, let's talk about high probability trades. So, trading at its lowest and crudest level can be compared to gambling. Now, it is not gambling if you know what you're doing. It is a statistical, mathematical endeavor where you can set very specific odds, use some statistics, and calculate your expected return. Now, in Las Vegas, the craps table, the blackjack table, the slot machines, is that gambling? Well, it depends. I mean, the patrons of the casino, they go in and, you know, they don't really know what their chances are. They're just kind of hoping to get lucky. That's gambling. That's the gambling side of it. As far as the casinos go, is it gambling in their eyes? No, it's not gambling at all. It is exactly what I just described as to what you can do with option trading. It is a statistical endeavor where you lay down exactly what your odds are, exactly what your payout structure is, exactly how, you know, the science and art, but let's talk about the science end of trading. That is what casinos do, Vegas odds people do. They're not gamblers, they're mathematicians. Professional traders, you know, what they call quants, they do the exact same thing that Vegas odds people do. They run the math, they look at the game, how the game works, and they play it in order to put the odds in their favor, to give them what they call in the business an edge. All right, now let's talk a little bit about how options are priced. Options are a little different than futures or stocks, that kind of thing. Like futures and stocks, if you're long it and it goes up, you make money. If you're short it, it goes down, you lose money. Or excuse me, if you're long it, it goes up, you make money. It goes down, you lose money. It's what we call in the business a binary or a binary asset. There's only two things that can happen: goes up, goes down. But options get a little bit trickier. And if we kind of take a step back from like how stocks really work and just say, I'm going to pretend like I'm no good at predicting the market. And maybe that's accurate for some people, and maybe some of you guys say, no, I'm actually really good at predicting the market. Fine either way. Stick with me on this. Let's just assume that you can't predict the market. This, by the way, is the mindset that financial professors take, quants, financial model people. I just read one of the questions. They're talking about people who program algorithms, algos. This is the mindset that all these mathematical traders and professors, doctorate guys, take. They say, I can't predict the market. Now, for a lot of people, that seems like a pretty crazy thing. Like, what do you mean I can't predict the market? Here I am sitting in this presentation. I'm listening to all these people tell me, here's how you predict the market. What do you mean not predict the market? Well, here's the thing. You may be able to have somewhat of a predictability factor in the market. Nobody can predict it 100% of the time. But if we start with the assumption that it's not predictable, and then you can predict it over and above that, then you can outperform and give yourself even a little bit more of an edge. We'll talk more about that later. So what we're looking at here, this is kind of a crude drawing. I'm a trader, not an artist here, guys. It's supposed to be kind of a log normal distribution, if you're familiar with that. It kind of doesn't look like one much. It looks more like a bell curve, which I think probably everybody's familiar with. Technically, stock prices are not distributed as a bell curve. They're distributed as what's called a log normal distribution, which is basically because stocks can only go to zero. They can't go into the negatives. One used to think that about interest rates, although we know that that's not true anymore. And they can go to the upside to infinity, and there's an interest rate component to it. So moral of the story is it's a log normal distribution. There's a measure when we're talking about bell curves or log normal distributions called standard deviation. Now, standard deviation is, well, kind of really what the name implies. It measures and then thus standardizes deviations from the mean, or let's just say from the current stock price is a good way to look at it. It's a measure of volatility. Now, this, guys, might seem sort of abstract. It might seem like something very different than what you were listening to earlier, maybe different than what you thought you were going to be hearing today. But this is at the heart, the very center of option pricing. When Fisher Black and Myron Scholes back in 1973, I believe it was, published their first paper making the Black-Scholes option pricing model famous, this was at the very crux, at the very heart of that model, philosophically and mathematically. Now, what if we could kind of take that concept of I can't predict the market, and we can place our bets in such a way that the probability of success is in our favor. So not saying, well, I can predict it better than anything else. No, we choose strike prices in such a way that even if we are unable to predict the market, we can still end up usually with a winner. The way we do that is with credit spreads. There's a few other types of spreads that can take advantage of statistics and probabilities. We're mainly going to talk about today is credit spreads. Now, here's the goal. There was somebody here, and I delete the questions on my end because otherwise it gets too cluttered, and I end up not answering people's questions. But somebody said, and I read the comment earlier, said, well, I learned that I can lose money by buying options. Kind of paraphrasing, but that's about what he said. So there's kind of like a little bit of a cult in the options trading community that sort of lives by that and says, well, I'm better off selling options rather than buying options. And there is actually something to that. I mean, it's never universally true. There are times when options are actually underpriced, but overall, statistically, in the long run, on average, options are actually overpriced. I'm going to show you how that works in just a second. So there's sort of like a little cult, a little sort of subculture of option sellers. But there's some problems with being an option seller if you don't do it right. You know, what you want to do is you want to sell here, take advantage of time decay, because options lose money as time passes, all else held constant, and then buy it back later. Maybe let it expire. I don't know. We can explore that later. You want to buy it back for less later when time decay makes it worth less. Just like when you short a stock, you sell high and later you want to buy low. Here we're selling the option high and later we're going to buy the option at a cheaper price, much cheaper price. So with option trading, even though we make money from time decay, we could potentially lose money if the stock goes in the wrong direction against us or if volatility changes. Now, if I sell a naked call or a naked put, I run into a situation where I can have extremely disproportionate risk. I can stand to make, 50 cents and I could lose $20 if the market crashes or something, extremely disproportionate. In fact, in theory, if I sell a naked call, my risk is unlimited to the upside. Now, in practice, I don't know if that's a 100% accurate statement because I've never actually seen the stock go to unlimited, trading at infinity. I've never seen a stock trading at infinity dollars a share. But theoretically, your risk can feel unlimited. I'll tell you what, if you sell a naked option and there's a huge move that goes against you, it feels like you have unlimited risk. That is for sure. All right. So the solution to this, what I guess I'll call a problem, is the credit spread. The credit spread is basically where I sell an option and then I buy another one as an insurance policy. So with a call, I basically sell a call that's out of the money and I buy a higher strike call in the same expiration cycle on the same underlying. A put, I sell a put that's a little out of the money, below where the stock's trading, and then I buy a lower strike put in the same expiration, same underlying. Now, I have been in the options business since 1993 is when I started down on the trading floor as a runner. Low-level job, and I worked my way up to being, one of the biggest traders in my pit, the Ford Motor Company pit. And so I've been doing this a while. I've been teaching options for a while. Market Taker Mentoring has been in business for over 8 years. We put over 2,500 students through our classes. I know what's going through a couple people's heads. Some people have an aversion to spreads. And they say, well, wait a minute. I like to just sell naked puts. And if I sell a naked put, I can, my potential profit is whatever I sold that put for. But if I do a spread, that means I have to buy an option. I waste money buying that option. I don't make as much if I do the put credit spread, right? Who here in this room was thinking that? I know some of you guys were, because like I said, I've been doing this a long time. I do a lot of these presentations. I know what you're thinking. Chris says, not me. Good, yeah. Well, first, I will say, caveat, there's nothing wrong with cash secured puts in like an IRA type scenario. I personally use them all the time. However, in your trading portfolio, I like using these credit spreads because there's an added layer of protection. If the market crashes, if you find out the CFO's cooking the books, if a stock gets taken over in the case of a short call, you can have this huge loss. And the fact of the matter is you can make just as much if you do a spread rather than selling a naked option. Now, you guys who have this version, you're probably thinking, no, you can't. This Passarelli guy, he doesn't know what he's talking about. You can't. You're wasting money on the option you're buying. Well, guess what? What if instead of selling one naked call, you sell 2 call credit spreads or 3 call credit spreads? You can take in just the same amount of money, if not more, and have a fraction of the risk. So the whole thing about credit spreads is it's basically selling an option. Like each of the options that are part of the spread, they have their own role. The short option is the trade. The long option is the insurance. Yes, Chris. The long option is the insurance. All right, so here's how this works. Let's say I sell the 50 strike call and I buy the 55 strike call. Maybe the stock's at like 47. Now the lower strike call, the 50 strike call, is going to be worth more than the 55 strike call. So I'm going to take in a credit, thus the name credit spread. The most I can make on this trade is the credit that I take in when I put the trade on. Now for those of you, by the way, who are listening to this and you're like, yeah, I know what a credit spread is. This is just a little bit of review, just chill for a second here, because I'm going to show you something today in this presentation, compliments of me, that is going to make your trading better. That's probably a new thing to most of you guys, even people who've been trading for a while. So stick with this. I'm just trying to catch up the newbies here, all right? So the most I can make is the credit received when I put on the spread. The most I can lose is the difference between the 2 strike prices minus the credit received. So let's say I sell the spread at $1. And again, it's a 50-55 call credit spread. Well, 55 minus 50 is $5, minus the credit received is $4. So I can make $1, I can lose $4. Now, here's some pushback I'll get from people who have never traded, never shorted an option before and aren't really familiar with this idea, and they think, wait a minute now, I can make $1 but lose $4. That's terrible. That goes against everything I was ever taught in Trading 101. I'm supposed to make more than I lose. Well, it's a little bit of a abstract philosophy here. It's a little different. If every time if I can make 1 but I can lose 4, if this is a coin toss and half the time I win, half the time I lose, this is a terrible way to do it. Because if I do this 1,000 times, I'm going to make $1 500 times, and I'm going to lose $4 500 times. It's terrible if it's a 50-50 thing. And that's what it is when you buy futures or buy stocks. It's a 50-50 thing. Here, though, it's not 50-50 because we're selling an option that's already out of the money. And when we go back to our little, probability curve here, imagine that right here, stock price is the mean, and that's $47. If I'm selling the 55 call, well, what happens? Well, if the stock goes down, I make money. If the stock stays where it is, I make money. If the stock goes up a little bit, I make money. So the permutation of events that can happen, there's more permutations that lead to me making money than there is to me losing money. In fact, the stock has to move against me kind of a lot in some cases for me to actually end up with a losing trade. So that is why this is a high probability trade. Now, how do we measure the actual probability? Well, we can use something called delta. Delta is the rate of change of an option's position value relative to the underlying stock price. But it's got another definition. Delta is the likelihood of an option expiring in the money. All right? So now hold on a second. Where do these numbers come from? Well, if you have an options-friendly trading account, like this is the Options House screenshot from Options House, they give you what is called your Greeks. Now, Greeks are something that when I was a professional trader, I used every second of my life. Traders that are not professionals, but you know what your broker calls you, retail traders, the ones that are successful, they use the Greeks every single day of their life too. This is how you should set up your option chain. Free advice. Bid, ask, delta, theta, vega, implied volatility. Some people like to put volume and open interest in there too. I'm all for that if you'd like to, if you got space. But those are all the essential things. So where does this number delta come from? Well, it's basically a byproduct of the option pricing model. It's calculated using some pretty high-speed math, at least for a typical person who does not have a degree in mathematics or something. And it's based on a number of inputs, like how far out of the money it is, what the volatility is, how many days there are until expiration. And it's a mathematical formula. It gives you an estimation for your chances of success. And here's how this works. The delta of the 80 calls is 0.4203. So what does that mean, 0.4203? Well, that means there's a 40% chance of the 80 calls being in the money at expiration. That means there's a 42% chance of the stock being above the 80 calls at expiration. All right, so let's kind of think about that here. How can that help us in this credit spread thing? Well, let's go back to our little thing here. What if I sold the 80-85 spread, sold the 80 calls and bought the 85 calls, you know, and maybe the stock is down at 75. Well, there's a 42% chance based on the delta of the stock rising and being above 80 at expiration. Remember, if the stock falls, I make money. If it stays the same, I make money. If it rises from 75 up to 80, I still make money. Only if it goes above 80 do I start to get into trouble. So there's a 42% chance only of that happening. That means the chance of that not happening, because the stock's got to be either above or below 80, chances of that not happening is 58%. So that means I've got a 58% chance of this trade making money if I sell the 80-85 call spread. Now, this is not me, you know, just pulling numbers out of my head saying, oh, yeah, we have a 99% chance of winning because I think it's going to win. Or because this is such a strong, you know, candlestick chart or something. I'm not saying that kind of stuff. I'm saying mathematicians, the University of Chicago professors who came up with the options pricing model, the original options pricing model, and consequently the Greeks, they measure it out for you. They show you exactly how to estimate your likelihood of winning. These are numbers that you can use as a guide. And you know, there's no fudging them. They are actual numbers where you subtract this from that, and that's the number. It's not like, oh, I think there's a 78%. No, it's not I think anything. It's what the numbers actually are. So with these credit spreads then, if you sell out of the money options, you always end up with a high probability trade. And now we need to consider, well, what can go wrong? Well, I'm basically trading two things here. I'm kind of trading direction and I'm trading volatility. I'm going to make money on time decay, but let's just say my risk is, well, it could go the wrong direction against me. If it goes a little bit against me, I don't care. If it goes a lot against me, that's when I run into trouble. And volatility can change. Now, that means a couple different things. It means the market itself could be too volatile, leading to a big move against me. Or it could mean that the volatility component in option prices, which is called implied volatility, could rise and it could make the spread worth more, which is the opposite of what I want. this case, because I'm selling the spread short, I want it to become worth less money. That's how I profit. So, all right, a couple of ground rules here. Always know your max gain and your max loss when you're trading, well, when you're trading anything. We want to set this up as a high probability trade. We're going to have, and I kind of change these numbers a little bit every now and then, but I'm saying I want between 2 weeks and 6 weeks until expiration. Anybody have any rules of thumb that are a little different than that, or anybody have any questions as to why I say that? Why would I say I want to put on a trade that has between 2 weeks and 6 weeks until expiration? Now, I might be okay with a 1 week, with weeklies. I might be okay with that if I can take in enough premiums. Sometimes premiums on weeklies are too small, but if I can get a big enough premium on weeklies, I love them. Nobody has anything? What's going on here? It's either really good or really bad. It either means everybody fell asleep, and I don't think I'm that boring, or okay, now I got some comments. Chris says he's not sure. Okay, good. Well, that's why we're all here today. And Jim says typically 2 to 4 weeks. And yeah, you know what, Jim? Some of my presentations I say 2 to 6 weeks. Sometimes I say 2 to 4 weeks. But you're right. Yeah. In fact, for me personally, I can't remember the time I sold an option with more than 4 weeks. So you know, I'm kind of setting some loose guidelines. Every once in a while, there's a monthly option. I don't want to sell the 1 week, but the next choice is a 5 week. So I guess that's kind of why I say keep it under 6, because every once in a while, when there's no weeklies, you have to end up putting on a 5 week or so. Okay, so Mr. Iyer says, because that's where you get your maximum decay. Yes. So all options are not created equal, guys. You, as a trader, need to be greedy. Remember what Gordon Gekko said in the first Wall Street movie? Greed is good. You can't just go and sell a spread and say, well, I don't know if this is the best spread to sell, but, you know, it should probably do okay. That's not your job as a trader. Your job is to say, well, I could sell this spread, or I could sell this spread, or I could sell this spread. Which one, A, makes me the most money, and B, has the least risk? That's your job. Because you know what, guys? You have to be kind of greedy to be successful. Because you are going to have, you know, if you trade every week for 5 years, you're going to have a lot of winners and you're going to have a lot of losers. You know? I mean, if you're trading these credit spreads, you're going to have a lot more winners than losers statistically in the long run. But you're going to have some losing trades. And when you have those losing trades, some of them are going to give you a disproportionate loss. One loser can erase 2 or 3 winners sometimes. If you don't manage your risk, one loser can erase 5 or 6 or 7 winners. So you've got to maximize your results. You can't just say, well, you know, this is pretty good. You know, it's like if you're a race car driver, you don't just say, well, yeah, somebody just give me some car to be in the race. What is this? It's a Ford Festiva? Yeah, it should be fine. It doesn't matter. As long as it's a car, I'm fine. No, that's not what you do as a race car driver. You say, okay, look, here's the conditions, here's the kind of tires I need. You know, it's hot, so I have to have this kind of gas. Or I don't know anything about cars, but I'm just giving an example, you know. You need to have the right car to maximize what you're trying to accomplish, to go as fast as you can. Not just any old car, the right car. So options that have less time to expiration have higher time decay. So when you're selling options, you want to sell options with a small amount of time because they decay faster. They make you more money. You maximize your success. Your winners will be bigger. Now, some people say, well, wait a minute, I think this stock could stay below 80 for 2 months. I should just sell a 2-month option. Why don't you sell, instead of 1 2-month option, why don't you sell 4 2-week options during that 2-month period? You will make more selling 4 2-week options than you will selling 1 2-month option. Aha! Light bulb moment, anyone? Aha moment? John here says, as former Viking coach Jerry Burns called it, you have to have killer instinct. Yeah, you do. You have to go out there and say, how am I going to make the most I can on this trade and have the lowest risk also. So there's actually another reason why you take a shorter period of time. You guys know what the market's been like lately, the S&P 500, right? I assume most of you guys follow the stock market. Let's try and predict where the market's going to be at the end of the week. All right? Chris says toppy. I think it's a little toppy too. In fact, I think it potentially is a lot toppy. But by the end of the week, where's it going to be? My guess is it'll be within 1.5% from here, and that's generous. Where's it going to be in 2 months? Goodness knows. I have no idea. If we're 10% lower or 10% higher, I would not be surprised. It's probably not going to sit here for 2 months. It's been about 2 months since it's started in this extremely tight range. But the more time there is until expiration, the less certainty you have of where it's going to be at expiration. So there's arguably less risk with the shorter term trade. You have greater predictability with fewer days. Urza says, other news. Okay, so no earnings or other news expected before expiration. Urza says, well, what is other news? Well, I mean, if it's a if it's a motor company, like I said, I was a market maker on the trading floor in Ford Motor Company. I would look for auto sales figures to come out. There's same-store sales. There's, everybody's looking at the Fed and interest rates. When the unemployment number comes out, everybody's watching that. There's lots of other news scheduled. Like just the other day in Apple, we had the news coming out of Ireland or the EU or whatever, where the EU is telling Apple that they owe billions of dollars in back taxes. That was a scheduled news event. They said they're going to announce something. That's what they announced. So there's lots of other news that can come out that's besides earnings. David says, I thought you need a lot of time because the last 2 weeks has a lot of time decay. Okay, David, but here we're selling them. We want a lot of time decay. Time decay means the option gets worth less. When you sell something short, you want it to get worth less. So you probably had somebody tell you that, as an option buyer, and as an option buyer, you're right. If I buy an option, I don't want it to lose value fast. But as an option seller, I do. As for 2 months, what effect do elections normally have? John, I'll get to that. That's going to take us off track if I start going down that rabbit hole. All right, so that's what a credit spread is. These are all the important things that are involved. Now I'm going to show you what I had somebody tell me once was like a secret weapon. So I kind of call it almost tongue-in-cheek secret weapon because it's not. It's what every professional option trader does, but I think for a lot of people who are new to credit spreads, you're not yet aware of this. I'm going to make you aware of this today. Even if you're brand new to credit spreads, I'm going to show you basically, let's call it my secret sauce here. Again, not a big secret. Every professional trader I know does it this way. But this is how you need to do it. I'm going to start looking at direction. I'm going to look for a stock that has hit support or resistance and bounced off. 3 or more times is ideal. And then I'm going to use support or resistance to set the potential short strike of the option. I want to sell my option at or beyond support or resistance. Support in the case of a put credit spread, resistance in the case of a call credit spread. Then I'm going to move on to, now I'm not going to make the trade yet because there's one more filter I need to look at. Volatility. I'm going to see if volatility is updated, or elevated rather, and I'm only going to trade the spread if volatility is high. So here's a trade I did. This is a few years ago now. I keep this in the presentation because it's just a perfect trade. I've done, made many other trades since then, but it's just sort of so quintessential for this example because it was almost a perfect setup, and it actually started going against me and ended up making money. So I'll let the story unfold here. You're going to love this. Ralph Lauren was at 151 bucks a share. And on the daily candle chart, there was resistance at $165 a share. On the weekly candle chart, going back 2 years, there was resistance at $165 a share. Now that's almost 10% away from the current stock price. Then here is the so-called secret weapon, volatility. I use a volatility chart on each of my trades. Now, probably, I know how this goes too. If you're real new to options, you're saying, I don't use those. What is that? If you are one of these guys who's been trading options for the last 10 years and you're making a lot of money at it, you're like, yeah, I use these on every trade. This really is the secret weapon. Again, it's no secret for people who are making money. It's no secret for professional traders. This is what we look at. But if you're not using volatility charts, I can assure you after today, you will be, because this is where the real edge comes into play. So I look at this and I say, well, we're after earnings, so there's not likely to be a big event. So let's pretend that, those 3 earnings, where the implied volatility got really high before earnings, let's pretend that those kind of mountains don't exist. Like here, where volatility was high before earnings and then collapsed after, here where it was high and then collapsed after, here where it was high and collapsed after. So, what's barring those big earnings buildups of the red line, which is implied volatility, what's the average volatility? Well, it's kind of lower than it is here. If I get rid of those sort of mountains of volatility leading up to earnings, I mean, the average volatility is more like, I don't know, 28 or something like that. Here it's about 31.5. So one could say that, getting rid of earnings, implied volatility is a little bit high relative to itself, but it's also high relative to implied volatility. Chris says HV30 versus IV30, and you say only 30-day. Well, yeah, so there's 2 things here. Actually, to tell you the truth, I mean, you're saying only 30 days if you're implying that maybe it should be more than 30 days. It should definitely not be more than 30 days. I will say that a lot of times for historical volatility, I actually use the 20-day. So this is good for some of you advanced folks here. Why would I use the 30-day IV and the 30 or 20-day HV? Well, I use the 30-day implied volatility because, remember, I want to try and keep the time to expiration, ideally under 4 weeks if I can. So that's 30 days. Now, on the weekends, every once in a while, and this is rare, it's every few years, but every once in a while, something big happens over the weekend, and the market opens sharply lower, or potentially even sharply higher, on Monday. So, if you think about it, your options have volatility sensitivity even on the weekends. Even though you can't trade them, you can make or lose money on the weekends. I mean, it doesn't actually hit your account until Monday when the stock officially opens higher, but when the news is out, you know that you're going to make or lose money because of that. But now, historical volatility, that is the annualized standard deviation of the stock closing prices for the past, well, in this case, 30 days. If it's the HV20, it's past 20 days. So those are only trading days. It can't count weekends because there's not a closing price on the weekends. So 30-day implied actually kind of matches up even better, Chris, with a 20-day historical. It's more common for people to use a 30-day historical. That's why I left it in the presentation. But most of the time I'll use a 20-day because there's about, what, 21, 22 trading days in a month, in a 30-day month. So comparing 20-day HV to 30-day IV is more of an apples-to-apples comparison. So good discussion point, though, my friend. Thank you. All right, so in this case, volatility is high. Now, wait a minute. What does that mean, that implied volatility is high? Well, you know what it means? It means that options are overpriced. They're expensive. Okay, well, if options are overpriced, what does that mean? Well, it means we want to sell them. You sell things that are overpriced. You buy things that are underpriced. That's how everything on this planet works, but especially option trading. I imagine other planets as well, if there's life on them. So here's what I'm going to do. Because I had resistance at $165 a share, I'm going to sell the 165 calls and buy the 170 calls. That's my credit spread. So I actually put this trade on. I sold the spread for 65 cents. I think actually technically I sold it for 70 cents. I middled the market a little bit, but it's fine. Even if you sell it at 65, it still would have been a great trade. What's special about this is, as long as Ralph Lauren, which was at 151 when I made this trade, as long as it doesn't go up above 165, I'm golden. I make money. It has to rise 10% almost for me to run into trouble. If it falls 1%, 5%, 10%, 100%, I make money. If it stays where it is, I make money. If it rises almost 10%, I make money. If it rises more than that, I start running into trouble. My chances of winning on this trade were great. I mean, if I look at the delta, I can tell you exactly what my chances were. It was 80%, right? It's about a 20 delta, 0.1978, that round that to 20%. So that means I had an 80% chance of winning, 100 minus the delta. I love this trade. And I was able to sell it for 65 cents, which is way more than I should have sold it for because implied volatility was elevated. In fact, if implied volatility was where it should have been, I probably would have only got about 50 cents for this, so not quite as attractive of a trade. Now that's good in a couple ways because we know that our maximum profit is what we sold the trade for, 65 cents, and our maximum loss is the difference between the two strike prices minus our credit, so 435. I need a humongous move in the wrong direction for me to lose money. So I'll take this, make 65, lose 438. I'll take that what appears to be disproportionate risk reward, but when I factor in probability of success, it's awesome. And then the big thing about volatility is if volatility was down where it should have been, like 3 points lower, I would have only collected 50 cents. Right? So my max profit would have been 50 cents. My max loss would have been more. It would have been 450 instead of 435. So this trade is superior in every possible way because I look at volatility. Now Kathy says, how old is this Ralph Lauren quote? It's at 104, 105 now. So I pointed that out earlier. I specifically talked about that. This is about, what, 4 years old, I think it was? And I told you earlier that I keep it in the presentation because it's perfect. It was a perfect setup, and you know what happened, guys? Here's a little tip on management. This stock rallied up, and it got up to 165. So I was sweating it out. I was thinking, oh, my God, I'm going to lose money on this. This trade had an 80% chance of winning, and I'm still going to lose money. But you know what happened? Stock bounced off support and came right back down. So actually, I would argue that it's not just the log normal distribution. Because of support, because there was resistance there, I actually had a better than 80% chance. That part is not measurable, but resistance levels are resistance levels because they hold more often than not. Obviously, they don't always hold, but that was an extra thing I had on my side. So I take the 80% likelihood of winning and say, well, I actually have an extra thing that helps me above and beyond that. So yeah, this is like the quintessential trade. So there's really a simple series of analyses. Credit spreads, I mean, if this is your first exposure to credit spreads, they might seem kind of foreign to you, like, oh boy, there's all this stuff going on, I'm not sure how this all works, blah, blah, blah. But they're not really that complicated when you break it down. First thing you do is look for a stock that has support or resistance. If it has resistance, put on a call credit spread. Well, you consider a call credit spread like we did here. If there's support, you might consider a put credit spread. But then you look at volatility. If volatility is elevated, the odds are in your favor. You're the casino, not the gambler anymore. If volatility is not elevated, then you're just a gambler, and it's not worth it. Even if it is high probability, there's not an edge there. And then, of course, you do a little bit of a sanity check. Like, some people say, oh, yeah, look, I can sell this credit spread 20% out of the money. This is awesome. And you look at it and you're like, well, you're collecting 2 cents by doing it. You can make 2 cents and lose $4.98. This is the worst trade I've ever seen in my life. So you kind of have to do a little bit of a sanity check too. And then, of course, have a plan. I'm trying to cram as much as I can into a 1-hour presentation here for you. But, you want to learn a little bit about adjusting and a little bit about strategy management and that kind of thing. Now we've got some questions here in the audience, and I am going to take all the questions that you can throw out in the next 13 minutes because we're going to end here right at 2 o'clock my time, which is 3 o'clock Eastern time. I guess that's noon Pacific, right? Yeah, noon Pacific. So I've got 13 minutes. I am going to answer all your questions, but before I do, I want to point out a special. For all you guys are the troopers. You guys have been listening to these presentations all day, and you stuck around, and you hung out, and I saw that I was going to be last in this, and I knew that I was only going to get the people who really are willing to put in the effort and stick around and learn all they can. So I want to do something special for you, and here's what I have. Everybody go to this URL right now, this website, markettaker.com, markettaker.com/GC49. markettaker.com/GC49. Now, every day we have a class. It's called our Market Taker Live Advantage Group Coaching Class. It starts at 9 a.m. Central Time. That's 10 Eastern. And our head coach, John, who's a former Goldman Sachs guy, former First Options of Chicago guy, worked down in the trading floor at the same time that I did. And he opens up his trading platform, and he shows you real-time in the live market 10 actionable trading ideas in options every day. Now, most of these are spread. Most of these, of course, are income trades. Again, these classes are every day at 9 a.m. Central. And some people say, well, you know what, I can't make it at that time. That's fine. They're all recorded. These are not day trades or anything. They're, trades, swing trades to short-term trades. So most of the trades are fine. If you watch the recording of it, which you can get a couple hours after the presentation, you're still in great shape. In fact, over half the people who are enrolled in this choose not to attend live. So watching the recorded class is just fine. Now, the normal price of this is $997 for a quarter. Now, you look at this and you say, well, $1,000, doesn't that kind of seem like a lot of money? Well, what if, just hypothetically speaking, you could give someone $1,000 and they would give you back $5,000? Is $1,000 still a lot of money in that case? Because there's a potential for a scenario pretty darn similar to that. John, a former Goldman Sachs guy, gives you trade ideas every single day. And he gives you 10 every day for 3 months. If you can make money off 3 of those trades, do you think you could make $1,000 on 3 winning trades? Yeah. Yep. So I don't want you to just trust me. I mean, we have students who've been in this class for years and years and years. I don't want you to just trust me. I want you to try it before you buy it. So I'm going to give you an entire month of group coaching for $49. That offer is available today, right now, for people who are watching this live webinar. After this, well, then you're too late. Timing is everything in trading, isn't it? So go to markettaker.com/GC49, and just to kind of push you over the edge just a little bit, I'm going to throw in our 3 ebooks. We have 3 ebooks that are all a $50 value, and I'm going to give them all free to you today when you take this $49 trial offer. Our Intro to Credit Spreads ebook, for those of you who are brand new to credit spreads, that's essential. 6 ways to generate income using options. And then our best ebook, in my opinion, is 3 secrets to making money in any market. They're all instant downloads. All right, so the regular group coaching for 1 month, comes out to $332 because it's $997 a quarter. This month, this is basically a processing fee. Allison is going to manually enter you into our system, send you the email invite for tomorrow morning so you can be in the class getting trade ideas tomorrow morning. Plus, you get the Triple E bonus bundle, which is a $150 value for free today. Just go right now. Oh, and the best part is, you might ask, well, what happens after a month? Then do I have to pay full price? No. This renews at 40% off the discount price. It's $277 a month. So we're giving you a discount. All right. So Raj says, do the trade ideas include the stop loss? Yeah. John also talks about managing the trade ideas. He talks about managing the trade ideas. So, does it really do you any good for us just to say, hey, here's a trade, go trade it? Not really. It keeps you reliant on us, which is not what we want to do. We want to make you reliant upon yourself. In fact, our best success story was a woman named Catalin. She signed up for the class. She was in the class every day. And then after 1 year, you know what happened? She said, Dan, I'm going to quit group coaching. I said, Catalin, why are you going to quit group coaching? You've been doing it for a year. You send me emails all the time, tell me that you love it and that you're making money off the trades. Like, why would you quit if you're making money? She says, because you know what? I actually learned so much in this class that I don't need to attend it anymore. And that was like one of my happiest, proudest days since starting Market Taker 8 years ago. Some people sign up for this class just to get the trade ideas. But some people sign up for this class just to kind of be put in the head of a former Goldman Sachs guy every day and to learn how he thinks. This class will make you a better trader and make you reliant really upon yourself. It's kind of, you give a man a fish, he eats for a day, teach a man a fish, he sits in a boat and drinks all day if you teach him to fish, right? No. Teach him to fish, he eats for life, right? So this is kind of both. We're giving you fish, but we're teaching you to fish at the same time. All right, do we have any other questions? Bob says, how is, well, I don't know, maybe it's 277. It tells you on that page. Bob, if you go to markettaker.com/GC49, it tells you what the renewal is, and it is a discount off it's a pretty good discount off the regular price. So, oh, that's right. I set this up for $199. Yeah. Yeah, so there it is. You renew at $199. Holy crap, I forgot that I did that. Normally, when we run a deal, we let people renew at $277, which people are happy to do. But our marketing guy, Steve, created this, and he said, hey, you know what, let's really give these guys a pretty good deal. And I said, all right, fine, we'll try it. So yeah, this is an awesome time to sign up for this class because it renews at $199 a month if you choose to stay in. Whereas, people who sign up and pay full price are paying $1,000 a quarter. You're paying $199 a month. So yeah, we're glad to do it. Do we have any other questions about that class? Bill had a question earlier. He says, what tools do you use to find these good opportunities? Well, I'll tell you what. We have some scans and such set up on our platform, and we will show you those in this class. If you enroll, look, Bill, do yourself a favor. Pay $49. That's probably more. That's probably your commissions for the month of August were probably more than $49. If you make or lose $49 on a trade, you don't even notice it. This is literally just a processing fee. So do yourself a favor. Sign up at markettaker.com/GC49. It's the best trade you're ever going to make. This is a high probability trade and extremely low risk. How about that? All right, do we have any other questions? I've got about 2 more minutes, and I would be happy to answer any questions about the class. And I'll go back and show you the ebooks real quick while I'm waiting for questions. These 3 ebooks are worth the price of admission all on their own, really. Intro to Credit Spreads ebook, 6 ways to generate income using options, and then the one that we get the best feedback for is 3 secrets to making money in any market. John and I wrote that ebook together, and we're pretty proud of it. We're pretty proud of the feedback we get on it. So I mean that's $150 worth of value of ebooks anyway. So definitely take advantage of that. And then again, like I said, normal price is $9.97 a quarter. You get 10 actionable option trades every single day. Plus, we tell you how to manage them. Plus, they're mostly spreads. I mean, what do you have to lose? I can hear my computer going in the background, and I can tell we've had people enrolling, so good, welcome. Kind of figured we would because it's extremely, you're risking $49 to find out if this class is right for you, and I can tell you right now, Chris, 1 month from now, you're going to be pretty darn excited to be renewing and staying in this class. All righty. Bob says, is the focus more on the weekly options than the 1 or 2 months out? Well, Bob, it depends on the strategy. Like I said, we do mostly spreads and mostly income trades. So we try and keep those less than, ideally less than 4 weeks. Sometimes, like I said earlier, you have to go a little longer. And if we can find good weeklies, we love to do those, but we can't always find good weeklies. Now, sometimes, like every once in a while, John will find like a straddle candidate, or maybe just like a debit spread or a long option, And in those cases, he might end up going, a month or 2 out, or 3 sometimes even. So, like the market, the opportunity dictates the spread. What I like to tell our students is let the market tell you what to do. let the market tell you what kind of trade to put on. Now, again, like I said before, income trades tend to have not just their higher probability, but statistically in the long run, options are overpriced. And so that's why there's all these, like I describe it as kind of like a cult, like a subculture of option sellers. That's why they're like that, because they know that in the long run, you're better off selling than buying. But that's not always 100% of the time universally true. If you look at volatility charts, you'll find more opportunities to sell than to buy, but sometimes you'll find a situation where you're like, oh, it'd be kind of stupid to sell here because volatility is underpriced, So yeah, it's whatever the, Bob, it's whatever the opportunity dictates is how we set our expiration, how we set our strike prices. Remember, greed is good. You've got to use the exact right expiration, the exact right strike prices, and optimize your trade, because you want to have lots of winners, and you want your winners to be big, and you want your risk to be low, because sometimes you're going to have some losers, So you've really got to optimize. We're going to teach you in this class exactly how to optimize and exactly how to pick the best trade for each given scenario and how to identify what the best trade is. Raj says, when we need to cancel if we don't want to renew after the first month. Yeah, you know what, Raj? You're going to want to renew, but if you don't want to, that's not a problem. In fact, we don't want anybody to renew that doesn't want to. So we send you an email a couple days before. It's automatically generated. It says, hey, in a couple days, we're going to renew you at the discount price. If you don't want to be renewed, you can cancel here. So yeah, we alert you. We make sure that you can cancel if you want to. But like I said, you're not going to want to, because look, man. Truth be told, if you're paying $199 a month, and for example, if you can find one winning trade a week out of the 50 trades you get during that week, that's 4 trades in a month. If you have 4 winning trades in a month, you're going to make more than $200, and that's like worst case scenario as far as number of trades that you are going to like, I think. So, Bill, you are welcome, my friend. Well, it looks like we are out of time then. Thank you all for spending your time with me. Once again, my name is Dan Passarelli of MarketTaker.com, and please take advantage of this. MarketTaker.com/GC49. You're going to risk $49, and you get to see what the class is all about. Even if you just paper trade the first couple to see how it goes, if you're just learning. If you're brand new to this, by the way, this is perfect for you, because you're it's full immersion. Like when you're trying to learn a foreign language, they say you need immersion, just go to the country and get thrown to the wolves and try and speak. Here, it's the same thing. Hey, I'm new to options, good. You're going to watch a guy who used to work at Goldman Sachs every day finding trade ideas, showing you how to do it. It's full immersion. It is possibly the fastest way for you to become a successful trader. Bob says, it sounds like your experience really pays off here. Well, yeah, both John and I have been doing this for a long time. Between the two of us, we've got over 50 years of actual real industry experience. I started down the trading floor in 1993. John started on the trading floor even before then, and we've never left the options industry. So, yeah, between me and John, we're giving you 50 years of experience. All right, so once again, thank you all for attending, and welcome to all the new students we have. We're happy to have you, and we'll see you guys in class tomorrow. Have a great day. Trade well. Thanks for attending.